Hello everybody, Payments Professor here, and today, by request, we're going to be talking about positive pay. Well, that and reverse positive pay. All right, what exactly is positive pay and what is reverse positive pay? Great question coming from all of you out there, and I really do appreciate the question. Well, positive pay, reverse positive pay, they are tools that we have in the industry for being able to assist our financial institutions and their business customers. There are other terms that you're going to hear when it comes to counting tools. That's the way I like to think about them, or that's really what they are, that are available. And you'll hear things like ACH debit blocks or ACH filters. There's an old system called controlled disbursement, and it kind of makes a comeback every now and then too. But positive pay and reverse positive pay are ones that have been around for a while. Now, what exactly are they? Positive pay is available for primarily checking and ACH. And the way positive pay works is the financial institution is positive you want them to be able to pay something that is presented to them, whether it's a check or an incoming ACH item. Why are they positive that they know you want them to pay it? Because you will provide them with a list. On this listing will be the check numbers or the ACH entry information for all the checks and ACH entries that are coming in that you want to have paid. Now, what's reverse positive pay? Well, let's back up. Reverse positive pay. What happens with the reverse positive pay is all of your items come in, your checks and your ACH items, and they go on a list that is then presented to you, that you then have to, in reverse, instead of giving them a list, they're giving you a list, and you have to go through and say, okay, I do authorize all these entries, or there's some entries that I don't authorize. Sounds easy enough, right? Well, that's reverse positive pay and positive pay. But stop, we're not done. Because are there any problems with these? First of all, with positive pay, the problem can be that something comes in that is a check, or it is an ACH entry that you do as a business want to pay, but because you failed to get it on the list, it doesn't get paid. It could be a case of you issue a check in the morning, and right away whoever you give that check to, maybe it's another business or it's an employee who's leaving, and they go to the financial institution and cash it right away. Well, they're unable to because why? You haven't provided your list yet. Or you just forgot to put something on the list. Maybe you added a new supplier who you're paying via ACH and they go to debit your account. But because that entry is not on the positive pay list, your financial institution's doing what they're supposed to when they offer the service and sending it back. Flip it around. What's the problem with reverse positive pay? The problem with reverse positive pay is it takes work and effort on your business side. Now, it takes work and effort to be able to do positive pay. You got to make the list. But it's going to be daily on the reverse side, because daily you'll be required to go through the list and be able to get everything figured out and get it sent back. Something you kind of should be doing anyways, reviewing your account. But there will be times, and it depends on what's coming in on that day, of what your volume is going to be like, that you'll need to go through and review all of those items to determine what gets sent back. If you don't do that in a timely enough manner, you could miss the time frames for being able to return your checks or ACH items. Now, I've got a lot of videos in the making, and returns will definitely be one that we'll talk about a lot. If there's something that you want sooner than later, let me know. I'll see what I can do to get to it. So let's get to this. What does the Payments Professor say in conclusion when it comes to working with reverse positive pay and positive pay? The way to really think about positive pay and reverse positive pay is like this, or just to break it down and give you an analogy. Positive pay is like when you go to a party and it's an exclusive party somewhere or exclusive club. You go up to the door, and you know, we've all seen this in movies. They've got the list of people that are allowed to come in. You give them your name. Hey, it's Payments Professor here. They look at the list. Sorry, Payments Professor, you're not on the list. You don't get in. Now, reverse positive pay, the way it's going to work is going to be more like people are coming up and they're saying, hey, I'm so-and-so. In which case, somebody takes down the name and goes, oh, you're the Payments Professor, hold on. They make the list, and then they go back, they find the host of the party, or the owner of the club, and they say, we got the Payments Professor out front. Do we let them in? Of course you let the Payments Professor in. Thank you. But back to reality here. That's the way it works, is the positive pay, you got to be on the list. The reverse positive pay, a list has to be presented to whoever's the host in this case, and they decide who gets to come in. But Professor, the bank and the credit unions, they want to charge us for this service. Yes, they do, and they should, because let me tell you, just bluntly, it's costing them. For financial institutions to be able to offer positive pay and reverse positive pay, there is a fee involved for them. There is charges involved for them. They have to be able to go through and purchase software. And in the case of doing some of those returns, maybe not all, some of it actually is automated, but even in the case where it's automated, they still review reports. But there's a lot of times that they have to do manual intervention. I think of it this way when it comes to reverse positive pay or positive pay. Figure out which one's going to be better for you. But then think of it like this. It's like buying insurance, because you have it there. It is a safety net to be able to protect you, to give you a layer, an extra layer of security to help prevent possible fraudulent transactions from hitting your account, and being able to get them sent back in a timely manner should they ever hit your account, as long as you're using the tools. If you're not using positive pay, you're not using reverse positive pay, you are greatly increasing the chances that an item will hit your account that you didn't intend to hit, that is possibly an unauthorized or possibly a fraudulent item. Again, I look at it as like an insurance policy. I think it is the cost of doing business, and it's something that the Payments Professor, I highly recommend to you. You got any questions, you got any comments, put them down below. This video, as I said, was made on request by one of you out there. If you would like to have other videos made on a specific topic, send them to me. Messaging seems to be the most popular way. I don't know why people don't like commenting as much, but send comments. You can send emails to kevin@paymentsprofessor.com, or you can send me messages directly, and I would love to get that information out to you. It is really the goal of the Payments Professor to educate the masses on electronic banking. Thank you for watching, and hope to see you again in future videos or at conferences along the road.